Hello and thanks for watching this video. I'm AJ Kratofil, Managing Member, Vital Wealth Management. Today is February 27th, 2024. I want to share 22 slides on the markets and the economy, so let's get started. Topics for today include the U.S. economic growth, inflation, bonds and the Fed policy, and U.S. stocks. No recession in 2023. In October of 2022, Bloomberg Economics said there was a 100% probability of a recession happening within 12 months. The next month, The Economist published a piece titled, "Why a Global Recession is Inevitable in 2023." Despite many predicting recession, the economy grew at an above average growth rate. So let's talk about the US economy and the growth rate. On this graph, you will see that since 2001, the trend line growth for the US economy has been around 2%. There's been periods of time where we've grown above that trend or below, but in the fourth quarter of 2023, the quarter-over-quarter growth was 3.3%, and the year-over-year growth was 3.1%. That's pretty strong growth and better than the long-term trends. The U.S. consumer has held in strong during 2023. The next thing we want to look at is the chance of the future. What does the first quarter look like in 2024 for the economic growth estimates? Well, the Atlanta Fed does a great job of a GDP Now forecast, and they're predicting a 3.2% growth rate in the first quarter of 2024. The blue chip consensus is a little lower, almost at 2% you'll see here, but either way, many believe the US economy in the first quarter is still on the growth trajectory. Not only that, but the US productivity has increased. You'll notice here that after bottoming in 2022, on the right, you can see a nice increase in the productivity of the American worker. AI has not even started yet, as I don't believe that it has become an everyday part of the worker class community, but I do believe it will in the coming 6 to 12 months, and that could even help spur even more productivity moving forward. It provides a bit of optimism moving forward. If we take a look at the Cleveland Fed statistic, this is simply taking the 10-year Treasury minus the 3-month Treasury rate. The chance of a recession is currently at 70% in January, which is much higher than normal. With the Fed behind the curve fighting inflation, this predictive tool was behind the curve as well. So I'm not so sure if this is telling us a lot at this moment. As the beginning of the year in 2022, it was screaming the chance of a recession that never happened. So I'm wondering how predictive this yield curve measurement is at this time. But it is something I always keep an eye on. Inflation is declining quickly. So while it has stayed a bit stickier, which we'll talk about here in a second, in January of 2024, the headline CPI, and I like to look at the headline CPI, which is the light blue color on this graph, that is 3.1% year-over-year growth in inflation. That's if you eat and if you drive. So if you're using gasoline and energy and you're eating, those are the headline inflation. Core CPI excludes those two measurements, and the Fed likes to look at that for obvious reasons, as they cannot control oil prices or droughts or famine, so that it's important for them to see inflation from different levels and different statistics. But the good news is that after hitting a 9% rate year over year in the summer of 2022, we've come down dramatically to below the 4% average trend going back to the 70s in this inflation statistic. So while it's not back down to the 2% the Fed would like to see, it is down in the low threes, which is a good sign. That 3% growth rate that we're seeing in inflation, or 3.1 that is, has a 6-month average of 3.4%. And you will see on this graph the monthly CPI increases that make up the annual number. The index for shelter continues to rise in January, increasing 0.6%, contributing to over 2/3 of the January CPI. So in January, month over month, the inflation number grew at 0.3, but over 2/3 of that was shelter. So we want to talk a bit about shelter since everything else seems to be coming down. The component of current inflation. So the stickiest part of inflation, like I just said, has been shelter. And what you'll see on this graph is the contributors to headline CPI. And they just color code this, so you'll kind of notice that shelter is this dark blue color. And really, going back to May of 2022, while inflation has come down overall from the 9.1 to our current 3.1, you can see that shelter has actually stayed consistent in this metric and stayed on the high end, while energy prices have come down dramatically, and even helped for negative CPI month over month returns in May of 2023. But taking a look at this, you can clearly see that shelter's been the issue. Oddly enough, shelter is one of the few things that the Fed can actually control with inflation. By raising rates, they make home prices less affordable and therefore bring down the price. But record low growth rates or record low rates with households refinancing in 2021 has created a limited supply, holding prices pretty firm here. So I think maybe this time is different in regards to shelter. When the Fed had rates this low, it just everyone was able to refinance into pretty low rates and hold on to their home. I think it's important too to look at the S&P Case-Shiller National Home Price Index, because while the Fed is showing month over month increases in shelter, what's really happening in the marketplace when you look at the S&P Case-Shiller Index is really a flattening out to a slight downturn in U.S. home prices since October of 2023. Albeit it's not coming down a lot, but it's definitely not growing at record clips like it was a couple of years ago. I also think it's important to look at the companies that are on the ground, so looking at Redfin's rental tracker, which is accessible online as of February 9th, the median US asking rent rose 1.1% year over year. So 1,964 in January. It's the largest annual increase since March of 2023. Rents were unchanged from a month earlier. While rents ticked up from a year earlier, the bigger picture is that the rent growth is leveling off after surging during the pandemic and then rapidly slowing from mid-2022 to mid-2023. The number of recently completed apartments is near its highest level in more than 30 years, and the number under construction is just shy of its record. So the Redfin chief economist expects apartment completions to peak in 2024. So with all this supply coming on and a leveling off of growth rates, that should help reduce inflation in the near term in the next 6 to 12 months, which should drastically help the inflation numbers that are staying sticky high. So let's pivot here and talk a little bit about the Fed and their rate hikes. The Fed is raising rates chiefly because of inflation, right? So if we take a look at every rate hike going back to March of 2022, where we started with 1/4 of a point, and then in May of 2022, 50 basis points, 75, 75, 75, 75, 50. And since then, really since February of 2023, we've seen 4 1/4-point hikes. So they've been on the lower side of raising rates. And the last Fed rate hike here was July 26th of 2023. So it's been several months now where the Fed has paused. And my guess is that the Fed is done raising rates. And the big question here is, when might they reduce interest rates moving forward? So are we close to the end of the rate hike cycle? Well, the Fed is kind of telling you this. What you'll notice here is that this is a history of how the Fed has raised rates going back to 1993. So you can see they tend to kind of raise rates, flatten off for a while, and then cut pretty hard. When they do cut, they tend to cut swiftly. Again, in 2003, you saw a rate hike cycle up to 2005. They flattened out for a while, went on pause, cut rates. And getting to the current cycle here in 2021, you'll see one of the most dramatic increases in 40 years in Fed rate hike, which is probably why many economists thought we would have this recession. And there's going to be a bit of a pause here, I would imagine. And, that's kind of cooked in based on the last Fed rate hike being in July of 2023. When they cut rates, well, the Fed is telling you on the blue diamonds here that, by the end of 2024, they expect to be at 4.6, 3.6, 3%. In the long run, they want to be at 2.5. So the Fed is telling you they're going to cut rates. Now, the market has its own opinions, and the market isn't green. and the market believes they're going to cut rates a bit quicker than what they're saying. But at the end of the day, both are on the same side. It's just a matter of timing. So the idea here is that the Fed will lower rates while inflation's coming down and should continue to come down, and that will allow them to reduce rates. So if we take a look at the change in interest rates going back to December 31st of 2021, and that is the yield curve. What you'll see here is the 3-month Treasury all the way out to the 10-year, the 20-year, the 30-year. I like to look at the 10-year at times because that equates or correlates pretty closely to mortgage rates. So back then you could see mortgage rates were down in the 1.5 range on the 10-year Treasury. They went all the way up to 3.9, and at times they even hit 5% at points in 2023 until coming down to about 4.3% today here in February of 26th of 2024. So you can see that the short-term rates that the Fed controls on the far left are in the 5 range at the blue line at the top here. And long-term, the 10-year Treasury is still at 4.3 because I believe market participants are assuming that economic growth will slow a little bit, that the Fed will cut rates in the near future, and that they don't need to have very high long-term rates at this point. So adding duration to your fixed income might be a good idea here. BlackRock has a great graph here, and I like to focus on the middle part here where it says cash underperforms following a Fed pause. Well, we're in the middle of a Fed pause, right? July of 2023 was the Fed pause. The average 12-month performance following the last Fed rate hike, using the 5 different cycles going from 1994 to 2023, you can see cash produces a 4.5% rate of return. That's not bad for safe money. The short-term bond has done 7.5, and the US core bond does 11.5. Why? Well, they all have comparable quality rates of 4 to 5% in interest. The difference is when you're buying short-term bonds, you're locking that interest rate in for 2 to 3 to 4 years. When you're buying these core bonds, you're locking that interest rate in today for 5 or 6 or 7 years. With cash, you are locking interest rates in for 1 month, maybe a month and a half. And therefore, when the Fed does cut rates, depending on how they cut rates, if they cut rates very quickly, the very next month, your interest rate could be cut quickly and you didn't lock in the current interest rate environment. So bonds had a good year in 2023, finally. After 2 straight negative years of bond performance in 2021 and 2022, you can see that bonds in 2023 had a 5.5% return. There's only 1 year where bonds were lost more than 10%, and that was 2022. There's only been 10 years period where bonds lost money, going from 0 to 10%, and there were 29 years in which bonds had less than average of 0.3%, and an average return tends to be between 3 and 7%, and that happens 29 times in history. 17 times they've been better than average, and 12 times they've had a great year of greater than 10%. So the 2023 5.5% is above the average long-term return of 5. So pretty good year for bonds. Not the best year ever, but definitely a nice comeback after a couple of years of tough sledding. Let's focus for a second on the investor sentiment, because as I've noticed, the sentiment of the average investor has gotten a lot stronger in 2023 as well as 2024 compared to 2022, when there were some pretty good opportunities out there in investing. Remember, what I like to look at here is what direction do these members who have a $1 million net worth investment, what do they think that the market will do in the next 6 months? Well, historically, 37% of members feel that this pretty bullish on the stock market, 31% are neutral, and 31% are bearish. What you'll notice here is the most recent reading on Thursday, February 21st, was that 44% are bullish. And looking back, January 31st of 2024, you can see 49% bullish. So the bulls are winning the day at this point. They're above the historical average. So, with optimistic sentiment typically doesn't come cheap stocks. Cheap stocks typically come with below average sentiment. When people are really down on them is where you get the best opportunity. So I don't see huge opportunities in the broad scheme of the US market. But with that being said, there's also not a reason to make a dramatic change here, as these bullish sentiments are not off the charts in regards to the highest we've ever seen. But stocks also had a great year in 2023. So the range of returns for stocks in 2023, we saw 26.3%, and that's when you look at the S&P 500. The US stocks average return is 10.3, going back to 1926. And you'll see that, we had a great year in stocks to the right. 37 times we've seen greater than 20% performance in stocks, and investing after a year in which the stocks had a great year resulted in an average annual return of 10.5% historically. So, the idea here is that just because stocks did really well in 2023 doesn't mean that they have to do poorly in 2024. They can still kind of be at or around that average based on past history. But this also, just taking a step back, regardless of last year's returns, gives you a really nice viewpoint as to why you invest in stocks, frankly. I mean, the opportunity of gaining more than 0%, happens a lot more than chance of losing money. On this next slide, we'd like to discuss how diversification is key, and selling high and buying low is the optimal idea. And the concept here is that we're looking at each calendar year going from 2009 all the way through 2023, as well as year to date. And we color code and rank the best performer at the top to the worst performer at the bottom. And these are broad category styles and indexes that track them. So in 2023, you'll see that large cap stocks were the best performer. DM, or developed market equities, international stocks were the second best performer. Small cap stocks in orange were the third best performer. High yield bonds were in blue and were listed here. Real estate, REITs, were the next best performer. The purple is emerging market stocks. This is the concept of investing in Mexico, India, Brazil, Russia, China. And fixed income or bonds are listed just below there. And then cash and commodities. So commodities were the worst performer. The interesting thing was that in 2022, commodities were the best performer. So, the best performer oftentimes doesn't stay the best. They typically rotate down, and the bottom performer can come up and rise above. So it's important to have some level of diversification in your portfolio of a lot, but maybe not all of these, depending on your situation, but a lot of these areas of the market. So looking back at this, I do see some opportunities in things like small cap stocks that have, not been as great of a performer in the last 3 years. As you'll see, the orange line was the second worst in 2022 and only third best in 2023. So there are opportunities out there in the US market to invest and find opportunities for long-term growth that aren't just the Magnificent Seven that we often talk about in the headlines or on CNBC. The 2024 earnings scorecard. For Q1 2024, analysts are projecting earnings growth of 3.9%. For Q2, they're looking at 9% growth. For Q3 in 2024, they're looking at 8% growth. And for Q4, they're looking at 17% growth, all leading to about a 10.9% earnings growth or profit growth of the companies in the S&P 500 for calendar year 2024. 2024 profits in December of 2023 were estimated to be about 11.7%. So you can see that these numbers, although they look pretty good, they are estimated down just in the last several months based on the earnings reports that just came out here in January. All in all, if we get that kind of growth, that will make the stock market now trading at 20 times next year's earnings not look quite as expensive as it is because your earnings are increasing, so the valuation should be a bit higher. I'm a big fan of this. Ned Davis Research provides some insight as to how the market might perform based on the past. So they look at a 1-year seasonal cycle, a 4-year presidential cycle, and a 10-year decennial cycle. So every year that ends in 3, going back 10 years. So for 2023, they would have gone back to 2013, 2003, 93, 83, 73, and so on. So they go back and look at long-term at this data, and the blue line is what they thought the market would do ahead of time. the orange dotted lines what the S&P 500 actually did. And so there's always periods of time where things get, the markets get a bit ahead of themselves or too optimistic or too pessimistic. And that pendulum certainly swings, and we feel it in our portfolios. But long term, this is shown to be a pretty good, leading indicator, I guess, of where things might go. So if we take a look at 2024, Ned Davis sees kind of a bit of an increase to start the year, choppiness, maybe a bit of a sell-off here in May, and then a pretty nice third and fourth quarter in stocks leading to highs. We'll see how things play out, and there's a lot more important things like earnings or the path of inflation, the economy, and interest rates. But I do think this is kind of an important, insightful graph that shows you that the last half of this year might be stronger than the first half of this year. We shall see. But let's talk a little bit about the election, since it is an election year and it'll be here quicker than we know. U.S. stocks in a presidential election year, the average return from 1926 going to 2023, you can see the first quarter average return is only 1.3%. The second quarter is 1.5%. The third quarter is by far the strongest at 6.2%, and the fourth quarter at 3.3%. So usually the second half, hence the Ned Davis research cycle composite on the prior slide, the second half of a presidential election year tends to be a bit stronger. And if we take a look here, in general, presidential election years tend to see about 11.6% on average return. And again, on a presidential election, you'll tend to see 2.8% or so is the average performance of the market in the first 6 months, with a 9.3% growth rate in the second part of the year. With that said, the markets have had Biden as a president and Trump as a president, so I think they kind of know what they're dealing with to some degree. So maybe this time could be a little bit different, that we're not getting a new person in the White House that the markets haven't seen and don't know a bit about what they might do. Thank you for watching this video. If you have any questions or would like to reach out to discuss your situation in more depth, please feel free to reach out. Thanks, and have a great day.